Okay, we have reestablished our connection to Gil Luria. He is senior software analyst at DA Davidson, and he joins us now to talk about one of the big movers in the U.S. market today. Adobe shares are getting punished for some guidance that the market perceives as weak, but Gil is contrarian here, I think, at least today. Gil continues to have a buy rating on the stock and is not, I believe, Gil, you'll correct me if I'm wrong, not unduly concerned about what Adobe has reported this morning. Why not?
Because they reported a good quarter, they reported good guidance. The market is confusing the long-term concerns about AI and its impact on Adobe's business with guidance that was slightly below expectations, really entirely based on changes in currency. The US dollar's gotten a little stronger, so guidance was a little lower than expected. And when I say a little, I mean a little, less than 1%. The market is confusing that with that long-term concern that Adobe will not be successful in the era of AI. We think that's a profound misunderstanding of what Adobe's products do. Adobe's products don't just generate an image and then use it. Adobe's products help companies manage their entire marketing operation, which includes creative, which includes images, workflows, and sharing those across an organization, its agencies, etc. Those things are not at risk because you can find free tools online to generate an image. But that narrative is so strong that even the smallest miss is causing this knee-jerk reaction in the stock today.
You think the market is confused and mistaken. This is not a case of investors being nervous about a stock that's trading at 23.5 times expected earnings.
You know, I actually think the market gets it right most times. I think this is the market getting it wrong in a really big way. And I'll just contrast this with Salesforce.com. For whatever reason, Salesforce.com has this narrative that they're going to win in the era of AI, and the narrative now is Adobe's going to lose. And so Salesforce, which is growing revenue slower, earnings slower, and is at a much higher risk of making dilutive acquisitions, is trading at 28 times, while Adobe trades at 23 times, when I would argue their prospects under AI are not any different. If anything, Adobe's actually in better shape because they actually have tools that are in the market and broadly adopted, where Salesforce is just now introducing tools that they're hoping will be adopted. So I think there's a big dislocation here and a really big opportunity with Adobe.
You are keeping a buy rating in place. You have taken your price target down to $625 US dollars per share, but that's still well ahead of where the stock is now. What kind of multiples do you use to get yourself to $625 US dollars per share on Adobe?
Yeah, just the peer multiple, just what Salesforce and Oracle are trading at. If you apply that to Adobe, the stock is in the 600s. We did take the price target down a little bit. Our estimates went down again, mostly, if not entirely, on currency. A strong US dollar impacts the largest technology companies more than others, and it impacts them in different ways. We now found out what that is for Adobe. We made some adjustments, but there's still a lot of upside to Adobe shares, especially considering how far down they opened today.
And so you would regard this as a buying opportunity?
Very much so.